It wasn't not just technology companies that were reporting today. Some big banks also posted their earnings. Goldman Sachs, as well as Bank of New York Mellon among them. My next guest watches the banking industry closely. Dino Kos, managing director at Hamiltonian Associates. He's a former managing director at Morgan Stanley Asia, and he spent 2 decades at the New York Fed and survived. Well, thank you very much. It's good to have you with us, Dino. So what do you make of the earnings? One of the themes that I kept reading about when I read the results had to do with the fact that much of the profits that was being reported had to do with reserves, had to do with a lessening of reserves. So, okay, that's a good thing. But when you actually look at the business of banks, they're getting smaller.
Well, you know, it's a tale of two cities in a sense, because yes, you're right. It's like, you know, the reserves were coming down, so credit is getting better. Now that's a good thing. You know, it means that there's fewer bad loans on the bank's books. But as you say, on the other side, revenues were really struggling. So compared on a year-over-year basis, Q1 to Q1 from 2010, revenues were down pretty much for every institution out there. You know, and at this point, we're now almost 2 years into the recovery, where we're going to be hitting the 2-year mark in just a couple of weeks. So, you know, right now, we should be getting some momentum in the economy. We should be getting some momentum within the banks, you know, and the struggles that they're having in revenue is telling you that that there's an underlying sort of weakness in the economy, and that's showing up in their numbers. So, you know, yes, credit is good, but on the other hand, revenues are a struggle.
And this indicates really that there is not a huge demand, at least on the part of the customers of the banks. There's no demand for loans.
Well, exactly right. You know, and you can see this, you know, so commercial and industrial loans, or C&I, they're up a little bit. They've begun to tick up a little bit, but most of the categories are still declining. And so bank balance sheets, and you can see this in some of the recent reports, industry-wide reports, bank balance sheets as a whole are still contracting slightly. Nothing to panic about, but they're still struggling. And again, if you compare this to other cycles coming out of the recession of the 1990 recession, coming out of the 01 recession, you had demand for credit as the economy recovered, and you had banks ready to sort of meet that, because that, of course, that's how they make money. And, you know, in this cycle, demand is weak. Small business demand, especially, is still weak. Real estate loans, of course, are very weak. You know, and to some degree, you know, who knows? Maybe the banks are somewhat constrained as well because of regulations.
Well, that's what I wanted to get to next, was this whole idea of capital reserves, all right? So you've got a situation where, as you say, all right, 2-year anniversary, coming out of the depths of the recession, the banks don't have a huge amount of loan demand, yet at the same time, regulators, not only in Washington, D.C., but also in Basel, in Switzerland, taking a look at their balance sheets and saying, wait a minute, we're not so sure exactly how much in terms of reserves you've got to keep, but we want you to keep a lot.
Well, you know, what we learned during the crisis was that the banks had less capital than what was being advertised. And there's lots of reasons. We don't have enough time to get into that here, but the regulators
that's an encyclopedia.
There's an encyclopedia there, and clearly the regulators are shifting course, and they're saying, you know, we will demand that the banks hold more capital, and they will be holding more capital, substantially more in many cases. Now, that's going to sort of restrain the growth that the growth of the bank's balance sheets. It's also going to affect the ROE, the return on equity. And, you know, and you are seeing a number of banks in their comments, you know, that they're struggling to maintain returns on equity to the levels that they had in the last cycle. And this will be a struggle for them. So, you know, the banking industry as a whole is in okay condition. You know, you have to remember there's been a huge consolidation. We have 4 institutions now that have, you know, roughly half of the market nationwide. You know, that's much more concentrated than it was. So you probably have at the margin less competition. It's going to be good for margins. On the other hand, you know, if demand is weak, if the customers aren't there demanding your product, you know,
you're not making loans, and that doesn't put an asset on the balance sheet because it's not earning anything.
Exactly. You know, and some of the, you know, and in some cases, some of the banks that report reasonable numbers, it was because of trading, because of principal investments, because of sort of factors that investors can't be confident can be repeated, quarter after quarter. So you will have a lower multiple placed on, if you will, those earnings, which are of somewhat lower quality than something that's recurring.
That's consistent, that you can count on a regular basis.
Exactly.
So
right.
what do you make of the comments? And I'm sure you've heard them. You meet with people in the industry, you meet with potential investors, and everyone says, well, the banks are all getting a free pass because money is so inexpensive. They can go ahead and borrow money from the Federal Reserve, basically pay nothing for it, and then they can just go and invest it and make 3%, 4%, 5%, and the spread, it's lovely. But that doesn't go on forever.
Pimm, this is one of the many ironies of the situation that we're in. So both situations are true. We both have the government that is sort of leaning on the banks to hold more capital, more reserves, tighten regulations, and on the other hand, you have an interest rate environment that allows the banks to raise money basically for free and then invest it in securities and other kinds of investments. So both things are true, and you have this dichotomy where
I keep thinking
one
that maybe
arm of the government wants to punish the banks.
Right.
And the other one is rewarding
It
them.
depends. I almost feel like, if you're the head of JPMorgan Chase, like Jamie Dimon, or you're head of a Bank of America, like Brian Moynihan, that you have two telephones on your desk. One's a good phone, one's a bad phone, and it just depends which one rings that day.
Well, that's exactly right. But one thing about this situation where you have very low interest rates, of course, the banks are benefiting because they can get very, very nice and attractive margins. But on the other hand, and people have commented on this, you have a lot of people, individuals, households that are relying on interest income from their CDs, from
and that's minuscule,
and that is really minuscule. So so you do have this frustration out there that the banks are somehow benefiting, from sort of what's happened to some of these households because they're seeing that they're seeing the effects, negative effects of these low interest rates. They're not yet seeing the positive effects in terms of job creation, in terms of a growing economy, in terms of other things that would help their finance.
All right, Dino. So you got to look at some of the specific bank earnings. For example, Goldman Sachs. What does that tell you about that particular franchise?
Well, that they know how to trade. I mean, that really tells you that they just have a capacity to do this better than others. And they're very good making markets, taking advantage of that. Finding opportunities. Sort of utilizing their principal investments and other franchises, and they just seem to do that better than anybody else. Now, they did have the hit to earnings because of the prepayment of the Warren Buffett preferreds,
the convertible preferreds, yeah.
But excluding that, so it was a decent quarter. But again, even with them though, on a year-over-year basis, their revenues were down. So you still have, even with the Premier shop, JPMorgan, another one, Premier Bank, but on a year-over-year basis, their revenues were down slightly. So you are seeing that even the high-quality names, even they are still struggling to grow the top line.
So what kind of strategy for a bank works in this environment? You've got Goldman Sachs Investment Bank. They're going to continue to be the investment bank. JPMorgan Chase, they not only want to be an investment bank, big M&A operations, but they also want to be a big retail bank, and they've been pushing to expand their retail operations. Citigroup seems to have its own strategy. They want to be thought of not only as core in some U.S. markets, but they want to be overseas. What's the story?
I think you answered your own question in a way, because there is no single strategy.
I've been accused of that before. I'm sorry.
There is no single strategy, and sort of different firms are playing to their strengths. So Goldman is playing its strength in investment banking. JPMorgan looks like they want to diversify, sort of have multiple revenue streams, be strong in each one, and therefore, to the extent that one is down, hopefully you offset that elsewhere. Citi.
I didn't mention Bank of America. I'm just curious, with Merrill Lynch connected to Bank of America. Is that a strategy that's still unfolding?
That's still evolving. We may have to wait a little longer for that to really play out. But the point being that what you're seeing is different institutions are taking on strategies that are slightly different, trying to play to their strengths. We're just not going to have a situation where all the big 4 or 5, 6 major institutions have the same strategy. It will differ.
All right. So tell me, how do these all operate in an environment where I'm sure you, like everybody else, was looking at the news of Standard & Poor's putting the U.S. government's AAA credit rating on negative watch? We've debated, whether it was often, in the coming for many years. whether they're late to the party, whatever. But I mean, as someone that follows the banking industry, this has got to be a little bit, well, out of the ballpark.
Well, it was, of course, it was a surprise initially. But on the other hand, let's remember something. First, on sovereign debt, usually the rating agencies lag. That is, the market, it tends to be way ahead of the rating agencies. And what happened yesterday after the announcement? Treasury yields went down.
Right.
The market rallied. Right.
Treasuries rallied. They said Treasuries might be turned into negative things, and people bought them.
And people bought them. The dollar rallied. So this was, so the market looked at it, and, for all the hysteria that one read about, the market actually kind of, sort of ignored it pretty much. Let's also remember that when Japan was downgraded not that long ago, the market just kind of shrugged and pretty much ignored it. We have to remember that the sovereign borrowers are the most analyzed entities out there. People are looking at the U.S. government daily. I mean, there's tons of people looking at that. So how much value will the rating agencies add? They're really not going to add very much. Not going to tell us much that we don't already know. We already knew that there was a big deficit. That the
we
US
heard
has a lot of
something
debt.
about this, right?
We know that Congress hasn't really put a strategy on the table and acted on it. We do know that there's these risks coming up. So S&P didn't really tell us anything that we didn't already know. And again, the price reaction sort of tells you that. Having said that, it is a shot across the bow to Congress. And from a political standpoint, this is something that the proponents of tighter fiscal policy will use and can use to push their case to have Congress take a really good look at a long-term deficit reduction package.
How about this being a shot against Ben Bernanke and saying, all right, you're done with QE2, don't even think about a QE3. You've got your shot, June, that's the end of it.
Well, I don't know that S&P was thinking in those terms, and I'm not sure that it's going to affect the Fed's decision. The Fed will end QE2 on time, June 30th, and then they'll sort of wait and see. What happens towards the end of the year? How strong is the economy? What happens as gasoline prices, sort of act as a further drag on the consumer?
Right, I think is the word, right?
What happens with state and local, which is tight? What happens as the tax increases, which are scheduled for the beginning of next year, begin to come into focus. It'll be interesting. Life will be difficult for the Fed.
And we look forward to having you guide us through all of that. I want to thank you very much. Dino Kos coming to us from Hamiltonian Associates. Always appreciate it. Thank you.